Good morning. This is Brad Shively with Capital Management Corp. We are just waiting for a few more attendees, and then we will get started. Bear with us for 1 second. Thank you. Good morning. I think we're going to just go ahead and start this off right now. It's 11:02. Appreciate your attendance here, and thank you for joining us today for the Capital Management Corporation Q4 and 2020 Outlook webinar. Today is Wednesday, January 22nd. We are pleased to have Tim Call, Chief Investment Officer and President of Capital Management Corp, and Mark Livesay, Portfolio Manager and Vice President of Capital Management Corp here. My name is Brad Shively, and I'm going to just start off with a few brief comments here, and then we will dive into the deck here, followed by Q&A. As a reminder, we'll have a call and listen only mode, but if you have questions, there's a question box below that you can type them in. As we get questions, we will answer them throughout the presentation here at the very end. With that, we'll start with a few opening remarks. Heading into 2020, one lesson that we learned is no one knows how stocks will perform in any given year because so much can change. In 2019, the Fed quickly corrected its December 2018 mistake of raising interest rates as inflation stayed under control. The White House decided that a trade truce with China was the correct path, and the momentum built by tax reform and deregulation helped the domestic economy and the job market stay remarkably buoyant despite a trade headwinds in manufacturing. Overall, the S&P finished up the 2019 year up 29%. And with that, I'll pass the call over to Tim Call here to walk you through.
As Brad said, 2019 was a rather positive year, better than many forecasted. It was another year of forecasters predicting a recession. This time, their excuse was manufacturing-based, with a GM strike, a Boeing recall, and the global tariffs and trade wars made it so that there was pre-buying of inventory and then companies living off that inventory. These are transitory items, as it turns out. So General Motors is back in production. The trade wars seem to be being resolved, at least temporarily, and Boeing should start producing their MAX jets again later this year. So another forecast of recession that did not prove correct. The fundamentals of this economy are very strong, and we don't see a recession this year, and doesn't look like there'll be one for the following year at this point. And that's for several reasons. The Federal Reserve has lowered interest rates, and they're printing money again. They're growing their balance sheet. Monetary supply is up, and the velocity of money is up. There's a foreign cash inflow from several sources, such as repatriation of foreign profits due to the last tax law. Foreigners seeking positive interest rates, as interest rates are still negative in Europe, so they're buying our bonds instead of their bonds. And we're now exporting energy, so we're getting cash even from oil exports, which is quite different than previous years. We're at full employment, and it's record employment in the United States. We've never had this many people employed ever before, and their aggregate wage increases of 3%. So the average person's getting a much greater raise than that. And so that's because the baby boomers are, in general, the highest paid workers, and they're retiring at roughly $10,000 per day. So for aggregate wages to increase by 3%, that means as they are leaving the labor force, the actual wage gains of the average worker are much higher. Being American, they spend that immediately. Only 1 percentage point of the increase in pay is going towards savings, which means paying down student loan debt and mortgages. The rest is being spent, and the consumer is 2/3 or more of the economy. So that is the main reason why we don't see a recession in the near future. Where to focus on investments, we're going to cover near the end of the presentation. We see several opportunities, and in general, while the market went up a lot last year and is more expensive, you don't have to own the market. And so there's select opportunities that are very exciting right now, both from a valuation standpoint and a growth standpoint. So now I'm going to turn it over to Mark to provide a little bit more detail.
Thank you, Tim. The next slide, we've shown this one before, but it's a lot of the headlines from the prior year going into 2020. The interesting thing about these headlines is a lot of them don't change, but many of them do. I think if this was this slide was updated to actually today, one of the big headlines would be coronavirus. So that's the virus that is a lot of attention being paid to in China. People are comparing it to SARS from 2002, 2003 time period. So we do have kind of a historical context, but it's too early to know what's going to eventually happen with the coronavirus, but that would surely be one of the things highlighted. Most of the things on this list most of the headlines are negative. I don't think that will change. What is negative will change, but that it's negative will not. So we like to say the market climbs a wall of worry, and we have plenty to worry about. So that's good news. A quick review of 2019 shows, which would be at the far right edge of this chart in the bar, the market price return, this doesn't include income, was up 29%. In 2019, that was the fourth best year since 1980. Of course, going into 2019, we had just had a 20% correction, which is shown as that dot that says -20 and a little bit to the left. So everyone was frightened going into 2019, and there was not a whole lot to be happy about. As Tim mentioned, that people were predicting recession. There was inversion of the yield curve. The Fed was tightening too much. So, of course, we get the fourth best return since 1980. So short-term annual moves in the market are very hard to predict. Another thing that we had a lot of volatility in 2018 with the -20% return in the fourth quarter. So everyone expected volatility to continue to be very high in 2019, and we had a peak to trough 7% correction only in 2019, which is actually below average. You usually get around a 8 to 12% correction. So 2 of the last 3 years have not had much volatility at all, and then 1 has had unusually high volatility with a 20% correction. So the best thing to do to prevent you being hurt by this volatility is to have plenty of liquidity available for short-term cash needs to live on and to ride out these downturns. And if you blinked, you missed basically the 20% downturn in the fourth quarter of 2018. And even though it wasn't very long ago, I think a lot of people have forgotten that it happened, because now you hear, oh, we haven't had a bear market and this and that, and the market hasn't ever gone down. And it was just, 15 months ago that we were falling 20%. So when you read the papers about the market hasn't fallen in a very long time, I think they have a pretty short memory of that. So the next slide we're all eagerly awaiting is that strong operating environment heading into 2020. The breadth of the global economy is strong. 95% of countries have growing economies in 2020. So that it's a very strong breadth in the recovery from a slow operating environment. Most central banks are easing, or said another way, not tightening. So 65, and thank you, Brad. Growth in GDP is expected to be roughly 2 to 2.5%. Households actually are saving well above what they did pre-crisis, probably not as much as they should. As Tim mentioned, in America, we tend to spend what we get, but the savings rate is close to 8%, and there's really no credit risk in the system. So you have an overall picture where the globe is growing. There's no credit risk to speak of. Monetary policy is very easy. Fiscal policy is, with tax reform, pretty good in the U.S. Trade wars are getting better, and you have household leverage. So the ratio of how much people owe to how much people have is way back to the levels it was in the early 80s. And the consumer sentiment is bouncing around, as it always does, because that's very influenced by short-term events, but up near all-time records. So we think this is a pretty good environment for the overall economy. So we're happy with the overall economy. The market has seemed to pick up on this, I would say, in the last 4 months. The market's done very well, and there's a lot of momentum behind the market right now. So whenever you have momentum going one direction, you tend to get a lot of people, fear and greed take over. So this would be where greed is taking over because the momentum is on the upside. So you do have to be careful with entry points and with stocks that have kind of come too far too fast. So I would say not every stock in the market is at an attractive value, but we do think there are many stocks in the market that are at an attractive value and have good entry prices. So I'm going to go to the next slide, hopefully, and pass it back to Tim, who's going to talk about some of the other bullet points we had at the beginning.
So you'll notice that my slides work, so that's good. And we have a little focus on the consumer and employment because that is 2/3 of the economy. And what you see on this page is wage gains across the board. But importantly, the lowest earners are getting the largest wage gains. So those would be teens, people with less education, and you'll see those are the largest red bars, which are the more recent quarters. And so those are the largest gains in wages. And why that's quite important from an economic standpoint is that these people have less money in the first place. They tend to spend all, if not more, of their income. So this money that they're receiving immediately gets spent, all of it. And being 2/3 of the economy, the consumer is a very important part of the overall picture. When we look at key components that have caused recessions in the past, fiscal means the government, so government spending being tighter. We certainly don't see that in Washington. And long-term, while that's bad to grow the national debt, in the intermediate term, growing government spending helps the economy, helps economic growth. And even if they do tighten their belts, we expect spending to increase with the government because of entitlements. And just with the baby boomers retiring and receiving Social Security and Medicare, that alone makes it so government spending should grow no matter what. With industrial, there was a fear of an industrial slowdown because of the GM strike, the Boeing line closure, and the global trade wars with tariffs. And that's proven to be transitory as the GM strike ended, and the tariff wars and trade wars appear to be ending, or at least moderating. We will see a little bit of a drag just because a lot of inventory was bought ahead of the tariffs in order to avoid the tariffs, and as companies live off those inventories, they don't need to produce those items. So as inventories correct, we can see the overall economy for a quarter or two growing at closer to 2% rather than 3%. Oil or energy has caused recessions before. A spike in energy prices has been very bad for the United States in the past, as we were the largest consumer. Well, we are now the largest producer of energy and a net exporter. So instead of sending out hundreds of billions of dollars a year to buy energy, the country would actually benefit from energy prices rising now, as there will be an inflow of cash since we're an energy exporter. So it doesn't feel good to pay more at the pump, but overall the economy would actually benefit the next time this happens if we continue to be an exporter. With monetary policy, that is ridiculously accommodative right now for being in the what we believe the second half of the economic recovery. So for the Federal Reserve to lower interest rates 3 times, to be growing its balance sheet, which it's doing with repo agreements right now, and to see bank lending and an easier regulatory environment, it's very expansionary. Monetary policy tends to be the key item you want to look for first when judging whether the economy will grow over the next 1 to 3 years. So that's very positive. And then from a financial standpoint, there are some excesses, but not that much. The student loan excesses, the government guarantees many of those. And the government can print money, so that's not of immediate concern. And then when we look at other areas such as auto loans and private equity or junk bond issuances, they're just not large enough to cause a recession right now. So we don't think that is a near-term problem. And looking at the next chart, we are highlighting some of the opportunities that we find very attractive right now. So again, the market has done rather well, mostly large cap and technology, and what people define as growth names. This can include many companies that don't have earnings or earnings growth, but they're judged as growth for various reasons, and they might be quite expensive right now. There are other areas that have been overlooked that are about to have accelerating fundamentals. And so 5G it's being built out right now, and eventually we'll all have 5G phones, which can also work on the 4 and 3G systems. With biotechnology, there are many advancements being made, and we, like several companies that should have extremely positive announcements this year. In the lithium space, there were some setbacks for manufacturers last year, and the opposite should occur later this year. And so there should be a big swing in the fundamentals of these companies Then with logistics, some of these companies benefit greatly from the move to the internet, internet sales and retailing. Not only the delivery of the goods, but the returns of the goods. Maybe somebody has 5 dresses delivered and tries them on and only wants one and sends 4 back. So there's a big business in both directions. And again, for various reasons, some of these companies have been overlooked and have greatly improving fundamentals as we look out over the next 1 year, 3 years, and 5 years. So we're very excited about these segments and specific companies in these segments. So you can buy companies and build a portfolio that has much lower valuation multiple, and we believe takes on less risk than the overall market, while not giving up on growth. You might actually build a portfolio that has greater earnings growth than the overall market will see over the next 1, 3, and 5 years. So we're very excited about these opportunities. Now I'll turn it back over to Brad.
Just a few closing remarks before we get into question and answers. As we begin 2020, uncertainty exists for stocks. An election year that adds political volatility to the usual economic and policy variables. But what history has really taught us is stocks fluctuate. Over time, they have gone up, often in years you least expect it. That is why we continue to look for opportunities to invest in high quality, strong cash generating names with long investment horizons. With that, we're going to just wait to pull together the questions we're seeing popping up here now. And once again, if you have a question, you can just go ahead and type it in to the question area and we will address it here. So bear with us 1 second. All right. First question we have. I believe you stated that 2019 overall market was up 29% for the year, but conservative investment accounts did not come close to that. What does CMC plan to do to improve or take advantage in 2020 if we have another up market?
So different styles go in and out of favor. Small caps and value and dividends have been out of favor for the last few years. We saw dividends move back into favor late last year. And in general, over long periods of time in the past, small caps have outperformed mid caps and mid caps have outperformed large caps. That just hasn't happened in recent years. And similarly, value outperforms growth by a slight bit. But what we've seen in the last 3 years is growth outperformed value by around 30 percentage points. Large cap outperformed small caps by around 30 percentage points. And then people more interested in FANG than in dividends. So these areas are oversold. And historically, that provides a great opportunity. So again, we think you can build a portfolio that can take advantage of that and have very strong results in the future, and possibly with far less risk, because usually in a pullback, the overvalued stocks pull back the most. So when we look at conservative portfolios, almost all portfolios up strong double digits last year, but dividend-focused ones or those that contain value stocks or in mid caps and small caps did not keep up with the technology stocks. But they also didn't take the amount of risk and in general, they produced a lot more income, a lot more dividend income. So it's a different animal. And in years where the market gets very excited and the technology and growth stocks have returns above 30%, most other categories will not. But just to keep pace and be in the 20s is rather good. And then in the out years, you should see great benefits. And so we have rather strong long-term results, and it's because we stick to our disciplines, and we already see some of those coming back into style, such as the dividends. But I don't think it will take long, especially with this economy, to see many of the value sectors and the small and mid-cap names to participate more fully in this stock market. So I think some of this will take care of itself. The main trick is to keep a long-term focus and maintain your disciplines, and we certainly will continue to do that.
Next question. Should we be concerned with lower growth projections? Mark?
Yeah, I would always be concerned with lower growth projections in the economy. I would say that our, at least internal and my belief, is that growth is going to accelerate. So if we did start to see that growth was going to really fall off a cliff, I think we would be concerned, but I think we have the opposite view right now. Because we believe the consumer, as Tim mentioned earlier, is going to continue to be very strong, and the government spending is going to continue to go up. And perhaps the manufacturing and industrial side of the economy, which had been kind of the anchor, so to speak, holding us down, those trends are going to improve. So I think globally, growth is actually going to accelerate this year, but it is something we'll keep our eye on. And if it comes true that growth is a lot lower than projected, that is something to be concerned about. That would probably benefit our more value and income focused styles if that were to happen. So I think that's what I'd say about that.
Next question. Obviously, it's a political year. What would you see happening if Bernie Sanders is elected president?
This is Mark again. So Sanders is a socialist, which is wildly different from what we've been living in the last 200 plus years with capitalism. So I think the initial market reaction would be negative because I think the tone would turn more negative towards corporations. So I wouldn't expect things to go well. I would say, though, however, there are checks and balances in our government, and I don't think that would be fully going socialist would be very popular, and I don't actually think it would happen. So I think a lot of the change would be more rhetorical change and not actual change if that were to happen. But I do think, the initial take of the market would not be good. So we would need to be aware and keep our eye on that. And certainly I think it's going to be hard to miss the different ebbs and flows of this political cycle. I think that's going to be the focus of much of the media and probably much of the country as well. And I'll let Tim speak to that as well.
When things move too far in one direction, sometimes there's a knee-jerk reaction the other way. And so this reminds me of if a Sanders were to be elected, that reminds me of more of a 1994 situation where going into the Clinton administration, Hillary Clinton was trying to get a different healthcare law passed that was seen negatively by Wall Street. And when it became clear that she would not be able to get it passed and that the Democrats were about to lose the Congress, the markets rallied. And so what you saw is a change in leadership. And so it helped to actively respond to that change. But people didn't like what they saw, and so they voted for a change. And it just happened within that 2-year period. So I think that's a possibility. Of course, if people think someone is rather bad for the economy, they might not get elected president in the first place.
One last question here, it looks like. And once again, if you have a question, please feel free to type it in. Looking at your attractive opportunities, you mentioned lithium, rechargeable batteries. Does that mean you would be looking at names like Tesla, who have a rechargeable battery vertical there? They don't make any money, but it seems like that would be a lithium play.
And we do have our disciplines that we follow. So we only invest in profitable companies that generate lots of cash internally. And with that cash, they can reinvest in their future growth, and they can reward shareholders directly with dividends and buybacks. Tesla does not meet any of those criteria. So it's never had a profitable year. It's never generated cash. And its valuation is ridiculously high. So it's almost tied with Volkswagen as the second most valuable automobile company. Only Toyota is higher. So Tesla right now is valued higher than General Motors and valued higher than Ford. Both of those are profitable companies right now, and they make some very profitable SUVs, which can subsidize their entry into electric vehicles. And we're going to see every major auto manufacturer enter the electric vehicle space. If they have not done so already, they should be entering over the next 12 months with major lines. And they will receive some government subsidies that Tesla no longer qualifies for. So we think Tesla will have some considerable headwinds. They have some positive characteristics, some good technology. We've seen similar situations before with solar energy, with ethanol, unprofitable companies with some neat technologies, but in the end, they were not good for shareholders. And we think that will be the case with Tesla. So what we're invested in is are very profitable companies that make the lithium in the first place and refine it. What you need for these batteries are more and more pure lithium, and then lithium formulated in such a way with other catalysts and chemicals. So there are only a couple of companies that can produce this material, and to produce it in a cost-effective way can be extremely profitable. And so those are the companies that we're invested in and think will do extremely well over the next 1 year, 3 years, and 5 years.
Thank you, Tim and Mark. That gives a little insight about definitely the way we think here, I think, and that's helpful. Just in closing here, I just want to highlight, if you are in the Richmond area around February 6th, Capital Management Corp will be partnering with Quater accounting firm and the state attorneys of Armstrong, Bristow, Farley to do a kind of high-level conversation around some of the new tax laws around stretch IRAs, caps, and such, and how that's impacting it. So if you're around, please be on the lookout for an invite there. So with that, though, we will close our webinar here. And if you have any follow-up questions, please feel free to reach out. And thank you very much again.